What's going on, family? I want to give you a real estate market update, and it is July 8th, 2023. And a lot has happened this past week that I want to dive into and tell you how you can take advantage of it. Now, what sets me apart from a lot of YouTubers is I like to give you the facts, but I like to position them in a way in which you can take advantage of the facts to get you the best outcome possible, as opposed to scaring you and causing you not to act and just be paralyzed with that fear. Because in this real estate market, yes, it is tight inventory, but there is a lot of opportunity. You just have to know where to look and how to position yourself to take advantage of that opportunity. So let's jump into the real estate news for this past week. This week, we heard about mortgage interest rates, mortgage demand. Also, employment numbers came back, and that has had a huge impact on mortgage interest rates. And lastly, we're going to address the Fed's meeting minutes, which came out this past week, where we got to see behind the scenes on what they talked about during the last Fed meeting. Let's jump into it. First, let's talk about jobs and how the ADP report, which talks about private industry jobs, well, that added 497,000 jobs in the month of June. Now, that's more than double what was anticipated and expected.
Wow.
Now, if you go back to my videos from January, you will see where I talked about how the Federal Reserve wants the economy to cool down. And one of the ways in which they see the economy cooling is the jobs reports. It's very hard for the economy to cool off if the economy keeps adding jobs. That means it's putting more money back into the system. And for a little while, just recently, we saw jobs numbers come down. But this last ADP report, now again, that's private sector jobs, more than doubled expectations. That is not a good sign of a cooling economy. And while it's a good thing that people are employed and more people are able to have money, it's a bad thing because that means they're able to spend. I say they, us Americans are able to spend more, keeping prices higher for longer. Now, this jump came at a huge surprise because, as we all know, the Federal Reserve has been raising interest rates to try to hamper things. That hasn't been the case. So while they paused last month in June, I'm not sure they're going to pause on raising the federal funds rate this coming meeting because the job numbers are blowing the expectations away. Now, you may be wondering, all right, the job numbers came back higher than expected, but what does that have to do with the housing market? In fact, it has everything to do with the economy as a whole, and the housing market is a large portion of the economy. So once the ADP report came out highlighting the extreme growth in jobs this past month, you saw the 10-year Treasury note shoot above 4%. Now, again, you might be wondering, okay, Treasury note, jobs, what does that have to do with me and housing? Well, mortgages follow the 10-year Treasury note. And when that shoots up, mortgage rate shoots up as well. And we've seen this past week that mortgage rates got as high as 7.22% for a 30-year fixed rate. And that's for people with great credit. Now, that 7.22% for a 30-year fixed rate has been the highest reading we've gotten for a 30-year mortgage in the past 10 months. It hasn't been this high since November of 2022, and the highest it's been in the past year is 7.37% back in November of 2022. Now, we weren't that far off from the highest it's been to what it was this past week at 7.22%, and that is because while we thought the economy has been cooling, that job number that just came out has proven otherwise and is showing the Fed that they're going to have more work to do, meaning increasing the federal funds rates sooner than we all expected. Now, before we go further into mortgage interest rates, let's talk about the Federal Reserve minutes, which we got this week talking about their last meeting. We got to see behind the scenes on what they expect moving forward. And moving forward, they made it clear that there will be, or they believe there will be, future increases in the coming months of the federal funds rate. They do not expect there to be a cut. So those of you thinking and hearing that the Fed is going to make a cut regarding the federal funds rate, according to their own meeting, they don't believe so. But we all know, depending on what happens in this world, that could change. Now moving back to the housing market, mortgage interest rates, and mortgage applications. Now, regarding the housing market, there is a record low amount of new listings coming to the market every single week. That does not bode well for those people wanting a housing crash or wanting prices to decline, because you need more supply. You need supply to outweigh demand. Demand has seen a drop as well. We've seen a 5% drop in mortgage applications this past week with the increase in interest rates. Now, that's an over 20% drop from this time last year, where rates were right around 5.3, 5.4%. Now, for the average person, it is about $700 more per month for a home payment, a home mortgage payment, than it was this time last year. That's because rates right now are above 7. And last year, not only were home prices less than they are right now, but rates were, like I said earlier, 5.3, 5.4% for a 30-year fixed. So what I see happening in the next 30 to 60 days, if interest rates remain elevated, I see inventory starting to build, and I see days on market creeping up. Now, these high interest rates may be a negative for a majority of people, but for people like myself and those looking for opportunities, this is a blessing in disguise, because these higher interest rates will do two things. One, they will cause the occasional onlooker or home buyer to bow out of the market. Secondly, they will cause the motivated sellers to raise their hand and be amenable to creative offers, lower offers, and just whatever it takes to get their property sold. Because in the past 3 years, people have been able to list their property and just sell easily. Now, that's relatively speaking, putting it in historical context. They were able to sell without putting much work into their property. You have had properties that are okay selling for at or above asking price, or prices that they would not have even dreamt about selling for even 2 years ago. Well, these higher interest rates are going to cause the casual buyer to exit the home buying market. And that's going to leave the buyers that are just concerned about the numbers, meaning so long as the numbers work. Yes, I understand the payments are higher, but rents are higher as well. And so long as the numbers work for you and you can find a deal or make a deal that works for your numbers, this is a prime opportunity for you to make offers on properties where days on market are high and the seller may be motivated. Now, you don't know if they're motivated until you make that offer, until you submit something to their agent. So the only way you're able to know if a home seller is motivated is to put in the work. See what those properties are, find the number that works for you, and offer that number. Just because a home is listed at $500,000, but the numbers work at $450, we'll offer $450. And if it's been on the market for 60, 90, 100 days, the agent might think their seller would never take an offer at $450, but you don't know what that seller's going through. The stress that's on their shoulders as far as carrying 2 mortgage payments or just wanting to move and relocate, and they're trying to do so before a certain time period. You submit your offer and it may not be what they expected, but it's their best offer to date. They may be willing to work with you. And if you want to get creative, you might be able to talk about seller financing, buying subject to. There are various strategies in which you can buy a home in a high interest rate environment. Real quick, I'm editing this video and I forgot to mention assumable loans. As a buyer, an assumable loan is an excellent way in which you can buy a property and assume the mortgage, the FHA, VA, or USDA mortgage of a seller that had a 2, 3, or 4% mortgage. So that will offset some of your mortgage costs because you assume such a low mortgage. Be sure to subscribe to the channel, hit that bell icon, because later this week I'm going to put out a video on assumable mortgages, the pros and cons. Now let's get back to the video. So in this high interest rate environment, there are ways in which you can put deals together and make it a win-win situation to where you can help the seller and help your buyer if you are diligent and put in the work. So in the coming month, you're going to see more videos about a housing crash because of these high interest rates. Let me ask you something. This past fall, when interest rates were above 7, did we experience that huge housing crash that they said was coming in 21 and 22? Also, back earlier this year when interest rates got above 7, did we see a huge housing crash that they said was coming? The answer to both of those questions is no. We have not seen a huge housing crash. That is because for the majority of the country, supply is still being outpaced by demand. Now, yes, 7% interest rates is going to calm demand down, but we're also seeing record low new listings come to market. So while inventory will pick up, it will not pick up drastically to where it will depress prices by 20, 30%. I just don't see that happening based on the numbers and based on the data. But there are strategies and ways in which you can take advantage of these higher interest rates and find properties that have been on the market for a little longer and make aggressive offers for those. I hope this was helpful. I am Sir Ashley, your real estate advisor. Talk soon.